We've discussed the Federal Reserve, and we know that one of the things that the Federal Reserve does is that it regulates banks. So let's begin by talking about one of the main regulations that it puts on to banks that you and I use every day, which is the reserve requirement. And so here I've just gone out to its website so we can just kind of see from the source how does it describe its activity here. It says reserve requirements are the amount of funds that a depository institution, the banks that you and I use every day, must hold in reserve against specified deposit liabilities. In essence, let's say that you have $1,000 that you want to put into a bank account. That would be a deposit liability because you could always go back to the bank and request that $1,000 back. Within limits of the law, the Board of Governors of the Federal Reserve has sole authority over changes in the reserve requirements. Depository institutions must hold reserves in the form of vault cash, right? So this is the actual vaults that banks have, and they must have a certain amount of cash in that vault, or deposits with the Federal Reserve banks. Those are the 12 Federal Reserve banks that we've discussed previously. There's a lot of extra information here, but if I just scroll down, you'll see the reserve requirements table here. And it's a pretty simple table, but for most banks that have over $89 million in net transactions, which is most of the banks that we have in America, the reserve requirement that they have is 10%. And so what does that mean? That means that if you put $1,000 into that bank, that it must take $100 of that $1,000 and it must hold it in a vault. It must keep that money in a vault basically as an insurance against its normal activities, so that it has money to finance its activities and that it has money in case you show up and want to take your full amount back, or maybe you want to withdraw some amount of money out of that. So let's kind of look at how this ties into one of the main things we'll discuss here, which is fractional reserve banking. This is the banking system that we use in the United States and in most Western developed nations and most developing nations as well. And this would be where banks that hold only a fraction of the deposits as reserves. So I just discussed the reserve ratio, and let's use 10% here. So kind of got a simplistic case here. We've got you, and you've got $1,000. Maybe you were working during the summer, and you want to do something with that money. You can either put it under your mattress and hope that nobody breaks into your house, or you can do probably the safer thing, right, and put it into a deposit account, put it into a checking account or a savings account. So let's say that you put it into a checking account, you deposit into a Chase checking account. So what does Chase now have? Well, they now have $1,000 here. And that $1,000 is a liability to them. It's a $1,000 that they have to, they owe you, right? It's your money. It's not their money. It's your money. You have access. You have a claim to it at any time that you want. But Chase can go ahead and do something pretty interesting with this, right? What they can do is they can take this $1,000 and they can break it into two parts. They can break it into $900 and they can break it into $100. And this 100, right, where does this 100 come from? Well, this is just $1,000 times the 10% here that we were discussing, the reserve ratio. And why do they break it into these two different parts? Well, this would be the reserves that they have, reserves that they are federally mandated to hold on to. And now they've got $900 of loanable funds, as we've talked about. We take your savings and they are able to put it into productive enterprises for the economy. And so now we've got $900 worth of loanable funds that they can take into the economy and loan out for any number of things. For home mortgages, they can loan it out for business expansion, they can loan it out for any number of things that are going on within the community. And what does this look like? Well, they take those loanable funds and they loan them out to individuals and to corporations. And what do those individuals and corporations do? Oh, let me change the color here. They take that money and they are presumably going to use it. And let's just kind of go with the most simplistic case here. They're going to take that money and they're going to put it into their own account. So they get $900 worth of loans, and that then becomes a checking account for them. So they now have right? $900 worth of loans that this, so we'll say kind of, I don't know, we'll say that this is a second person. So this is the second person here, and they're going to take out a $900 loan for some activity that they're doing. Maybe it's to help finance a car purchase or something like that. And so they now have this $900 and they have some sort of activity that they want to do with it. It's sitting in an account now for them. And that $900 is going to be sitting in an account that they can now use, and they were going to deposit it. And what do they do when they deposit it into a second bank? Well, they're going to deposit it, and let's say that they deposit it into, I don't know, let's say that this is now Wells Fargo. And they deposit it into a Wells Fargo account so that they can then use it. Well, there are a number of other things that Wells Fargo can do with this, but we also know from the Chase example that they can now take this money and they now have $900 sitting into an account that this person has a claim on that they can use for that activity that they were looking to use it for. They might not use it all at one time, or maybe they will, but Wells Fargo is taking a number of accounts into right there. They are doing loans for a number of individuals. They are taking deposits from a number of individuals, and they have a couple things that they can do now with this $900. With this $900, they can split it into two different parts. They can split it into $90, right? Here in this, what would this $90 be? Well, that's 900 times 10%, because they must keep 10% of that deposit in their bank, in their vaults. And they would also have, what would they also be? They would be remaining here. They would have $810, and this would be their reserves, right? And this would be their loanable funds. And you can see how this would just continue and continue and continue as this money would continue to kind of go throughout the economy. What we're seeing here is a few different things. So one, we see these reserves here, right? That's money that's being held. But what is this $900 doing? Well, this $900 is getting repackaged into the economy. This is extra money that is being created by normal banking activity, by our ability, our trust that the bank will be able to pay us back, because they are putting together so many of these deposits that if any few individuals go and request all of their $1,000 back, that they would be able to piece that together from all the various reserves that they have in their banking accounts. And so we've got this loanable funds, and then we have Wells Fargo's loanable funds here as well. And you can hopefully see that what are we doing? Well, we're taking this $1,000 and we're multiplying. We're making it bigger and bigger and bigger. And this is the main key of the fractional reserve banking system. The main key here that we see is that the money itself multiplies. And this money multiplier, you'll often hear the money multiplier. It's the amount of money the banking system generates with each dollar of reserves. And so what is it? Well, you put this $1,000 in, and then we get $900 out of it. And then we get an extra $810 out of that, and this would keep going, right? And then it would be 10% of that $810, so we'd have $81 that the third bank would have to hold on to, and then the difference is what they would be able to loan out, and other banks and more banks would be able to loan out more and more money here. This multiplier effect. Let me just write it out here. The multiplier effect. It is, in essence, what is this reserve ratio? Well, this reserve ratio is 10%. The multiplier effect is just it is the inverse, right? It's 1 over what is it, right? It's 1 over R, the reserve ratio. It's 1 over 10%, right? This here would be 1 over 10% in our example, which is equal to 10. And so what are we saying? Well, it's 10x. All of this is going to work out to, we take this initial $1,000 in our banking system, and we are able to convert it into monetary. We're able to convert it into a money supply of 1,000 times 10, which would be $10,000. we are able to increase our money supply by $9,000 as a result of fractional reserve banking. And this is something that just takes effect in the way that we do our banking. You might not have given much thought to this. You may have just put your money into the bank and not really cared about what they do with it because you have assumed that you could go back to the bank and get it out. And in most cases you can. Your deposits are insured, so even if the bank went under, the government has insured it up to $250,000, which is something that came out of the Great Depression in the 30s as well. But the main key that we see here, and as far as economic growth, is that we have this multiplier effect, that we can take the deposits that we have, we can take the cash on hand, and we can turn it into even more ability to use for productive enterprises in the economy. It allows us to have more leverage in the economy as we're kind of growing the opportunities for individuals to use this money. This is the main key to banking here today, and hopefully this gives you just kind of a simple but good overview as far as the main keys that are going in here, the reserve ratio, the resulting multiplier effect, and how that can end up giving the economy a larger supply of money in the long run as a result of our savings and investment.